All right. So the topic here is divestment, right? Past practicalities, pitfalls, all of the stuff. And I'm going to try and take you guys on a pretty wide-ranging tour of this issue, and kind of explore it in an intersectional way. I'm going to take you through the way that we do things here, right? So like we're actually going to go into our live spreadsheet that drives everything we do, and I'll just sort of walk you through all the logic and how it works. It's relatively simple. Um, and then, we'll talk about how you can do it yourself. We'll talk about pitfalls, and then we'll talk to questions. We got a lot of great questions from y'all. I think I was blown away. We got 43 responses to our survey, which was probably 30x my expectations. So thank you for that. It really helped me tailor this to the stuff that was on your mind. I want to really stress though, I'm somebody who has presented on this stuff to like professionals, and I'm very given to monologuing. So if I'm saying words that aren't making sense or you have a question, just ask. I mean, it's not a big deal. We can keep it interactive. The slides are sort of just a loose agenda. Um, Disclaimer, this isn't investment advice. Please don't sue me. Thank you. Um, so Ethical Capital is basically a purpose-built firm that's designed to kind of work on, what I see as the original sin in wealth management, which is that we prioritize people based on how wealthy they are. So one of the things that is pretty unique about us is that we are open to clients with as little as $1 to invest. We charge everyone the same 1% fee. It's the only fee that we get. It's the only compensation we derive from our activities. And we are a fiduciary, if anyone knows what that means. We'll talk more about it later. It's me and my hench person, Gabe, at the moment, who sits in Connecticut. And we sort of, you know, uh, trade off and, handling client
Can you put
stuff.
your mask on for a second?
Do I have any good masks? Um, so uh, our philosophy, right? Like, what is the big guiding stuff here? I think that a lot of what we do is sort of an integration of traditional long-term investing practice as, kind of championed by folks like Buffett and whatnot. I actually spent close to, or a little over 9 years, what is time, working at this organization called the CFA Institute that was founded by Ben Graham, who was Buffett's professor at business school. And a lot of that basic accounting and research discipline pervades how we do things. Similarly, we stick to our process really freaking closely. Every new moon, we rebalance our portfolios and make sure that all of our clients have the most holistic, most current version of our investment criteria. And when we come across ethical issues as we're kind of going through the course of our lives, we tell our clients about it and ask them for feedback. Because I'm just some chick in Utah picking stocks. I thrive on that dialogue. Part of why I was really happy to join you guys today. Um, you know, Part of this whole thing is predicated on the belief that I can tell the difference between right and wrong. One of the things that you're going to ascertain as we go through this is that there really are a lot of judgment calls in ethical investing. It is, pretty tough to create, something like a standard stock index that really captures what you're looking for by investing in this stuff. So, what we do is, really a blend of art and science. We also are not, out here investing on vibes. Our clients, are not in a position to lose the money they have. We focus on companies that are generating real cash flow, and generating positive impact the same way they generate that cash flow. In other words, their operations are directly associated with positive outcomes. And, we don't have that many of those ideas. Right. So with most of our strategies, we manage three in-house and we combine them to customize for folks. Two of them are very, very concentrated. One has 18 stocks, one has, four or five positions. And then for folks who are kind of closer to retirement or in retirement, we combine that with a diversification sleeve to make sure that we actually keep you guys relatively aligned with the broader markets so that you don't miss out on any growth and, basically experience a random bad year. Um, so yeah, we already talked about the agenda a little bit. One thing I'll just note is that when there's a something that was raised in the Q&A, I highlighted it in green. Didn't get to everything. And when we get to the end, I'll kind of go through all of the questions that I didn't manage to integrate into this. Well, we're kind of feeding through questions from ourselves. But let's get started. What the heck is ethical and or sustainable investing? Well, according to me, it's imperfect, right? I often use the analogy that I'm basically a gardener, right? Where I'm out here planting seeds, looking at what's growing in which places, reacting to that reality, and just kind of updating. You know, Often companies will, like some of the least ethical companies out there, will put a lot of time and effort into appearing ethical. And I'll get to how we counteract that. But, at its best, ethical investing is a work in progress. Because the economy changes, reality changes, company changes. Um, we really try to, learn cumulatively as we go through our process, right? So that as we kind of research companies, we're, creating useful places to pick back up on in 2 years or 3 years when we re-engage with that company again, when it seems like it's having, uh, you know, when it's getting its time in the sun. We also are always on the look for new activist divestment demands and new activist reports on companies that are doing things that are not so great. And I'll show you how that feeds into our process. The important thing to note here, though, is that ethical investing is not in any way a standardized term. There are, ESG is often used as a synonym for ethical investing. The largest ESG fund, is like an abomination to look through. Like it's, Microsoft, Apple, Netflix, Google in the top holdings, and then you've got ExxonMobil before too long. So like there's not, we're always dealing with subjective, soft, and like kind of nebulous stuff and making judgment calls. Um, so let's go through kind of who we're drawing from as we think about this stuff. And, one of the things that I think is a unifying theme for all of, kind of divestment, ethical investing, is it starts with a group of friends. In this case, the literal friends, the Quakers, who like back in the 1770s, starting in the 1750s, but, the process concluded in the 1770s, determined that you could not be a Quaker if you owned or profited from slaves. And then over the course of the ensuing kind of 50 years, these troublemaking peaceniks organized large, cross-border boycotts that were specifically designed to target industries that were heavily reliant on slave labor. So the number one thing to know about divestment is it's best when you do it with friends, in part because then you can make more noise, right? And in part because then the thing can kind of take on a life of its own. Um, so South Africa is often kind of talked about as the time that, um, you know, this became relatively mainstream. And, I was born at the end of this timeline, so I don't have that much firsthand experience of it. But one of the things that's interesting to note here is that, 1962, the UN establishes its Committee on Apartheid. A full decade later, we're still in like we're figuring out what to do. Maybe we'll do an arms embargo. By the late 70s, we started to get organized campaigns emerging. But it wasn't until like the mid 80s that you started to see widespread divestment and widespread action. So like often when we're advocating for divestment, what we're really doing is building the soft infrastructure that can take a movement like, divest from Israel, invest ethically, however you want to frame it, and build it into something that has more than just personal tangibility. Um, and so I want to kind of work through an example here with you guys and sort of ask the question, did the divestment activists win? Right? Couple of really interesting factoids here, right? You started to see widespread flight of international corporations from South Africa by the late 80s. Every year during the apartheid regime, wealthy South Africans were exporting their capital to other places. Um, that actually accelerated after apartheid ended. Um, so I wonder, just put it out to you guys, does that feel like a victory? Does it like the way that I frame this, like how does it sit with you? I see Barbara talking, but I think your mic is off. Any thoughts? It's okay. It's okay if no one wants to talk. Uh, but like I would sort of contend that, we see, an acknowledgement from South African leaders that the divestment movement was a catalyst that really got them going on, this de-apartheidization of the country. But it's not necessarily the case that what you get after the divestment victory is a huge win for people in society. Right. And part of that is because often divestments are kind of advocated for in a color by numbers approach, where it's like, here's the 30 evil companies, um, and not so much associated with like a positive replacement vision for what comes after you get rid of the bad stuff. So like we were talking before we really got into it about the importance of intersectional thinking. Hoo boy. Um, Now let's chat about BDS and the divestment from Israel. Basically, in 2005, the BDS movement issued this call for three demands, which are listed there. And the occupation and colonization, recognize the fundamental rights of Arab Palestinian citizens, and recognize the right of return, right? We got a question about, is that anti-Semitic? Is this anti-Semitic? And I actually, found a really cool framework for whether or not something is anti-Semitic from, I don't know if anybody knows the Refuseniks, which were Israeli anti-war movement. This guy, Natan Sharansky, I'm sure I'm pronouncing that wrong, came out with these three Ds, where if you're demonizing, you're delegitimizing, or you're holding to a double standard, then you're kind of crossing over into anti-Semitism. When you're advocating for the rights of one population that's kind of not being looked after by the dominant powers, and you're trying to bring their rights and standing in accordance with international norms, I would contend that that's very far from anti-Semitic. And so would many of my Jewish clients. Um, Something I'll note is, if you look through the BDS literature, you won't see use of anti-Semitic symbols. You won't see like challenges to rights for Israelis. And you'll typically see things framed as Israel a country versus Israelis the humans and Jews the humans, which is an important and useful frame. Um, if you go through the kind of BDS literature, they've got these 34 companies that they prioritize for divestment. Part of the reason they're prioritized is because by concentrating pressure on these 30 companies, the activists kind of feel that they can have a bigger impact. And in some cases, they have. They actually managed to get a company that was building a rail system in Israel to completely withdraw from the country. And I've had a number of cascading impacts across many of these. Um, the Friends Service Committee, oop, wah, wah, wah. Oh no, what have I done? The Friends Service Committee, kind of goes a little bit beyond what BDS does and kind of calls out 34 or 234 additional companies that have problematic activities or exposure. And that's a common thing you'll see, where you'll have companies like Nestle, which, I think is openly evil, trying to privatize the world's water supply, that are, really targeted for action and pressure. The vast majority of companies don't get that treatment. So it's important for us to make sure that we're pulling from sources that are rooted in, products and conduct that is unethical, rather than just kind of focusing on the shiniest and brightest, kind of targets of the divestment. One of the great questions I got is why not just invest in Palestine? Um, as somebody who's a supposed expert on this stuff, I'm not even sure where you would start. The Palestinian Stock Exchange is tiny. You're literally dealing with less than 5 billion in total market cap across 49 companies, only 10 brokers who can get you access to it for trading. Not the kind of place I would advise retirees to put their money. Also, not the kind of place that I would
Okay.
necessarily know how to make a sensible allocation to. And I wish that was different. One of the things that sort of guides me in thinking about this stuff is like when you look at a chart like the one on the screen that has the total value of the Tel Aviv Stock Exchange against the total value of the Palestinian Stock Exchange, it jumps out pretty quickly that there's a fundamental inequity at play. Right, even before you get into the details, and figure out what is really going on. And that's a lot of what we have to do as we're kind of navigating this stuff is flatten these really complex issues into like, yeah, something's going on there, or like, I don't know. Uh, but the decision to keep pulling on the string or not is often guided by these sorts of high level observations that sort of highlight, all right, something does not make all that much sense. Um, how do we kind of respond to emerging threat stuff? Because one of the safest bets you'll ever make is that there will be another issue at some point, that people are concerned about and that merits a response in a portfolio. Um, we basically are constantly on the hunt for reasons not to own things. And it's a more cheerful exercise than it sounds. But we have this spreadsheet I'll show you in a sec that kind of helps us wade through the universe of about 10,000 securities and exclude all of the companies that we've kind of identified as having specific ethical shortcomings and move from that massive universe of possibility to a more constrained, like 25 or 100 or so companies, that we only have to check in on once or twice a year, which is exactly as much of an undertaking as it sounds like. Um, the criteria that we use are super wide ranging, and includes catch-all categories like tax chicanery, which is me politely saying, tax bullshit. The or carceral profiteering, which is my 50-cent English major word for private prisons. Um, there's a lot more, inside of this. Our full policy is available for review. It's actually open source, so that if any of you guys have foundations, community organizations, or whatever that are looking for a place to build their own ethical investing criteria, start with ours with my compliments, and I'm happy to guide you on how to implement. But the overlap between consumer harm and surveillance capitalism may not necessarily be that intuitive until you really spend time in the weeds. And what I mean by surveillance capitalism, by the way, is companies that track all kinds of data about you and then use it to sell to you. The most kind of virulent and terrible example is Facebook, which actually creates lists of people who are vulnerable to scams and sells them to scammers in annual conventions in Las Vegas. Which is like, I struggle to even characterize it. So let's go into the spreadsheet. And are you guys now seeing the spreadsheet, or are you still seeing the tab that I shared before? It's okay. It's still the same one. Okay. Let's stop sharing. Oh wait.
See the
Uh,
Throws up
spreadsheet's there.
when I grow up, I'll figure out how to work these things.
like a
Um,
spreadsheet
I
to
see the
me.
spreadsheet.
go ahead. Someone was speaking, but it got cut off.
You're, I'm seeing the spreadsheet, I
You're seeing a
think.
spreadsheet?
Yeah.
Okay, great.
Yes.
So basically what we do, this spreadsheet defines everything that we do. Right. And it's big. It's got, a couple thousand companies in it. Thank you, Javiria. The, basically it's all driven by this rating that I call tick, which is my, kind of integration of all sorts of things that matter to a company's investability, right? And they could be things like, the CEO has their head on straight and is like actually focused on things that drive value. It could be things like, wow, they haven't managed to retain a single diverse person. That sucks. But basically, what we do is whenever we come across anything from one of these companies, we update that tick so that we have this kind of ongoing stack ranking of our best ideas. Um, the exclusions that I talked about are governed by this tab over here, which kind of distinguishes between product and conduct-based issues. Right. So, important to note that you can be a pretty ethical company in terms of your products, but still be like out here ruining the world. Right. So we sort of look at it from those two dimensions. And whenever we come across a company that comes across that or that kind of, you know, seems sketchy to me, basically, we wind up digging in and, identifying whether or not it really should be excluded. There are a lot of third-party sources here that we use, that we'll get to later when we talk about how to divest your own portfolio if you want to do that. But, one of the things I'll note is that more than a third of our exclusions are from our own research. And that's a theme I'm going to keep coming back to because objectivity is nowhere here. And at the end of the day, you kind of have to make decisions. Also, a lot of the activist-led databases don't get updated that frequently. For instance, like the big emissions database only gets updated like every 18 months. So like there's a data lag problem that you need to kind of compensate for. We do that by being really proactive in our research. Whenever a company that has one of those tickers that's excluded makes its way into our investable universe, it gets flagged and highlighted, so that it doesn't sort of accidentally make its way into something. It kind of allows us to make sure that, we're not wasting time digging into companies that we've already deemed uninvestable for one reason or another. Um, you know, the And then when it comes to actually forming our portfolios out of this, we actually go ahead and just take the tick rating and use it to build the portfolios themselves. So this is our current holdings as of our most recent rebalance. You can see the ticks are pulled in. We've got weightings that are determined literally by adding up all of these ticks and then creating a percentage out of it, so that we've basically got a very straightforward decision aid that, kind of spits out something for me to respond to every time we're rebalancing this stuff and kind of forces me to logic through the trade-offs between each of these different investments. Um, the one thing I'll show you because it's kind of cool is we recently built this portfolio screener that allows us to pop in, really any portfolio of holdings and quickly get um, what we've excluded, why, and what the source is. In addition to, if we haven't excluded it, our notes and our ratings. So that's really easy to do, and I encourage you to take advantage of it. Feel free to reach out to me anytime and just say, "Hey, Sloan, can you run this for me?" Um, the other thing I'll just kind of note is that we're pretty dorky about tracking when we last looked at stuff. So we have logic in here that fires whenever we update these ratings, and that allows me to kind of go in and sort by, the stuff that I haven't looked at in a while or ever. Right? So that when I'm going in and having some spreadsheet fun time, I can really prioritize my activities. Are we back on the slides? Fun fact, my grandfather actually worked at Bell Labs and invented has some patents that are associated with the conference call, like the early conference call where people would connect wires. And I find it so funny every time that it's only gotten worse since that initial invention. Um, so how do we invest? Basically, our strategies are really focused on these, I call them primitive goals that people have, right? Which are basically long-term growth, income, and stability of capital, and diversification. Right? And managing these three strategies individually allows us to actually create a lot of customization for our clients when we need to do that. Um, Not all of them take advantage of that, but it's there. Um, you know, in our kind of flagship strategy, which is this growth thing, we are really focused on like I said, all the holdings drive impact the same way they drive revenue. And we think about the strategy as being spread across four big themes, none of which you'll find in traditional definitions of sectors. So it's a mix of innovation, infrastructure, lending, and real estate, which I sort of view as enabling components of, whatever the good future that we're hoping for is, right? We need loans in order to build that. We need places in order to experience it. We need to be connected to each other in order to, live in community. And there's always a need for new and exciting solutions to stuff. So like this up here in the top right might be familiar to some of you. It's called a style box. And it doesn't look like it's familiar to anyone based on the expressions I'm seeing. Basically what it does is it's a relatively standard way for fund managers to show what's in a strategy. And what you're seeing from that is that our right now our strategy tends towards smaller companies, which that are blended between relatively low price stocks and growth stocks, which tend to have higher valuations. I won't belabor these finance points, but one thing I'll just note is our cash flow yield of our strategy, which is a really nice indicator of financial viability, is more than 4 times that of our index. So it's not just that we're, kind of winning moral points. We're also really finding some good companies. And these are sort of like my pets, and I can talk about them all in as much detail as you want, but I'll spare you that for now. And just this is our performance in that strategy cumulatively and year on year. I won't go through all of these strategies in too much detail unless you guys want me to. But the basic upshot is that these component parts can be like really valuable components, or it can be what one builds their portfolio around. So let's talk about some common mistakes that I see all the time. And apologies in advance for getting kind of bitchy in overview of this stuff. The most important thing, the most severe mistake that I see all the time is ignoring the basics of investment management when focusing on ethical investing. Like we take clients with no minimum. I often get folks who are like, how did I wind up with $10,000? And immediately they want to give it all away. And there's nothing wrong with that. We encourage that, in fact, but it is really important to set clients up for success. And that's kind of the North Star of all of this stuff, is making sure that, you kind of don't fail the most important test, which is creating something that serves the client's objectives. You'll often find really sexy investment products that have really high fees and commissions, or that are sold by people who are not fiduciaries. Not chill. Just skip it, as far as I'm concerned. Complexity is really, really hard to counteract once it takes root in your portfolio. And the cost of it in terms of the ongoing oversight can be like more than most people are willing to bear. The other thing that I see a lot is, assuming that data has an equal value across the various places it might come from, right? Like we're often dealing with data from like AFSC, from, two or three other groups, from our financial data providers. And I actually forgot to show you, I'm just going to do this right now. I forgot to show you this neat thing that we use as part of our kind of research process that helps us root out deception and untruth in financial filings. And this was actually created by like one of my best friends and mentors who at our old jobs spent a lot of time doing some research on lie detection. Evan, I'll just answer your question quickly. A fiduciary is a type of financial service provider, or just a type of legal entity that must take only the best interests of the end client into account when building a portfolio. Not like, oh, well, if we do this, it'll generate a nice commission for me and I can get a steak dinner. There aren't that many great statistics on what percentage of investment professionals are fiduciaries. I would estimate it at less than 10%, especially for folks who have less wealth. It is very likely that the person who they talk to, even if they are holding themselves out as a financial advisor or something like that, is basically a salesperson, and will be, kind of trying to jam folks into whatever suits them. So I'll just show you this quickly because it's pretty fun and cool. Let's look at JP Morgan Chase. So basically what this does is reads through all of the company's filings algorithmically, and creates these, it's a little slow sometimes. It creates these nice mapped overviews of all of these disclosures that help us hone in on areas where there might be more or less deception or more or less truth, right? So for instance, oh, it really doesn't like the formatting here. That's really funny. All right, bad example. But the gist here is that let's see, let's get a K. Let's see. Mariana is asking, okay, a couple questions about fiduciaries. Let's talk to that. How does an entity get to be a fiduciary? You are regulated as one. So registered investment advisors are fiduciaries. Executors of wills are also fiduciaries. Lawyers can be fiduciaries. It basically, will be very clear in most client relationships whether you're engaging a fiduciary or not. What does it mean when you're willing to trade highest returns for ethical choices? That's a great question, and the case law on it is still very much developing. One of the things that we do that helps us protect ourselves from, kind of legal nonsense. First of all, we named ourselves Ethical Capital. Right. Second of all, we're really explicit about what we do. We have a really strict process. And our clients come to us for that. We actually don't have any clients who invest, unethically or without our, kind of guidance. So there is, in some cases, when it comes to pensions, when it comes to trusts and other kinds of highly regulated entities, there can be some complications about that. If you bump into that, if you're talking to somebody and they say, hey, we can't do that because of fiduciary duty or something like that, I got talking points for you. And I will set them straight very happily. Um, the, the one of the, kind of subtle or the knock-ons here is, might the fiduciary be unwilling to invest in lower earning investments, um, because that avoids evil? My experience of that is that investment returns kind of come randomly. And I used to think that there was this linear trade-off between risk and return, where you could take a unit of risk, um, and like trade it for a unit of return in a relatively straightforward way. I don't believe that anymore. Oftentimes, what you find is that there are some funds that are out there that have what's called concessionary structures, where they're designed to mostly invest in community. The point of them is not generating investment returns. And they very explicitly, will generate stuff that only matches inflation. Um, let's see. Jane asks about insurance against liability. We do carry errors and omissions insurance and comprehensive cyber and all kinds of other stuff like that. And it's important to do that. Because one of the fun things about being a fiduciary is that if I say you might really like a hot dog with mustard on it, and you go and have a hot dog with mustard on it, and do not enjoy it, you can sue me for that. Um, it would get thrown out. But all of our recommendations, and recommendation is pretty broadly interpreted by the regulators, are held to the same standard. Um, so yeah, I think, back to our little parade of bad things that people do, um, focusing on the negative, right? I think, like, in a conversation like this, I showed you one of the saddest slides in the world a second ago, where we had all these things that we exclude. And it's really easy to just sort of get, really into the ethics of an individual situation. And, there's heartbreaking stuff in public companies. It's no question. Everything from being under SEC investigation to having active shooters in the factory to, more casual or hands-off forms of neglect and malevolence. So I think, like, a lot of times when I talk to people, they sort of expect me to be a bit downbeat on the state of the world. But that's actually very much not the case. Like, there are 2,500 companies I haven't figured out a reason to invest in, or a reason not to invest in. And we work hard at that. So when you get that clarity that, oh, these options exist, it's a nice, window into considering the realms of possibility for our planet and people. And yeah, I totally agree with you, Jane. Divesting is so much easier, than investing ethically. And one of the weird things that happens sometimes is people just only do the divestment and then buy all the stuff they haven't divested, which is kind of silly in my view. And often winds up creating a portfolio of, like, many of the most boring and low growth companies that you can possibly come up with. Um, Another thing that is, I think, really, really important is revisiting your investment decisions, on a semi-regular basis, right? And that can be, on a vibes basis. Like, do I like the working relationship that I have? Do I feel like I'm communicated with well? Or it can be, more granular. I'm a fan of, excuse me. I'm a fan of revisiting stuff once a month just to make sure that um, our kind of highest level ratings are all intact. But I think that everybody, with everything in their portfolio, should be in a regular process of looking back and being like, all right, what did I think when I bought this? What happened? And what can I learn from the difference between those two things? Um, that's really how you grow as an investor. I mean, most of, the first like 15 years of my professional life were basically paying tuition in the form of, less than great performance as I experimented with all sorts of different things. Um, you know, the the other thing is that companies are rarely fit for all seasons and all weather. Right? Like we own a couple of companies that we've owned since the beginning of the firm, and that I could very easily imagine never selling. Um, that's mostly because they're pretty obscure. Stuff like, a random agricultural lender that, I don't see, getting picked up by the meme stock crowd anytime soon. But, a good decision at one moment could be a bad decision in another. And it's really important to get into that process of refining. The other thing, and I think like this is, investing broadly, not just investing ethically, performance measurement is freaking difficult. It is an entire subspecialty of investment professionals. And it's like, you know, if you want to think about a boring rocket science analogous thing, oh boy, I can show you the GIP standards. Almost no individual investors actually understand their portfolio's performance. Usually what happens is they'll focus on a couple of winners and be like, oh man, I'm up a lot on that GE stock or whatever. But kind of neglect the entire portfolio. And that's sort of a motivated reasoning mode that's very common for humans to get into, right? Like we all want to think that we're smart and that we're doing a good job managing our money. Um, the other thing is like the time horizons for performance data that people use most often, like 1 and 3 year measurements, are literally empirically very close to garbage in determining whether or not a portfolio makes sense or a strategy makes sense. Um, Almost no like due diligence professionals that I know will base their kind of decision making solely around performance. They'll go in and look at the process behind it. They, make sure that the team has some sort of consistent worldview, that they're doing something that's repeatable. But, often when a strategy is underperforming, that's some of the best times to invest. And overwhelmingly, it is when individual investors sell out. That doesn't mean like uh, hold on forever for dear life all the time. It means revisit your investment decisions and make sure they still make sense. Question from Mariana. I wonder if you put any money in ETFs or mutual funds from Parnassus, Calvert, et cetera. I sometimes put money in mutual funds, then drop them when I find they're investing in Chevron. Yeah, so in our diversification sleeve, we build portfolios that include broader exposure to the U.S. market. We try to do it in pretty creative ways. We don't use any Parnassus or Calvert funds right now. We would if they had ones that I liked. The Usually what I'm looking for is complementary exposure to what's in our existing strategies, so that we can kind of round it out. And we use like stuff from fund companies that you might know, like we use BlackRock for one thing, and that we use a firm called GMO for another strategy. Um, when we're looking at external funds, it's a part of our process in part because like we were doing it long before we started picking external funds. Because looking at the holdings of these funds is a great way to make sure that we're considering all the opportunities out there. Um, so we pretty regularly go through this big list of funds that we check in on and make sure that all of the holdings they have are reflected in our database. Um, but I think with mutual funds, broadly speaking, most of what you'll find is kind of a so-called closet index fund where, you have like maybe it has some criteria involved, maybe it's like designed to invest in women's leadership or diversity or whatever. But at the end of the day, it owns Amazon, Apple, Netflix, Google, Nvidia, Microsoft, Chevron, all the same stuff as everyone else. There was actually a really funny example of a climate fund that outperformed its benchmark pretty significantly entirely because of its investments in Nvidia, the chip maker, which is, I would argue, one of the largest emerging uses of energy. And just an outwardly silly thing to be in a portfolio like that. But most fund managers don't have the constitution to not own something that's going up, because we are evaluated in a pretty ruthless process where our performance is stacked up against everybody else. And not owning stuff, it takes a lot of chutzpah. Patrick asks, are there any good banks where we can keep our funds, e.g. Amalgamated? We own that stock. The so yeah, we got another question about Amalgamated in the thing, and I was smiling from ear to ear because I'm currently in the process of building a position there. I think it's like 4 or 5% of our flagship strategy. Um, that's that's a category of company that I could see potentially never selling, right? Because it's very strongly grounded, very well governed, and is part of a coherent system that creates positive impact. Um, so let's go through how to divest your own portfolio, and some links. And I think this is, whether or not you decide to do it, it's kind of fun to play with. The first thing I need to underline, exclamation point, and I don't know, underline again because we're talking about Israel and divestment, is don't use Morningstar data when you're doing this. Most advisors will use Morningstar data. It is the most common advisor workstation, and one of the largest providers of sustainability ratings. However, they explicitly exempt Israeli companies from their human rights criteria. And since this article ran in Jewish Currents almost 2 years ago, they further lessened their oversight of Israeli companies. So there's a problem when you're using third-party data, which is that, like, it's not necessarily the case that the people who are creating that data are doing it the same way the whole time. These guys all want to satisfy their constituencies or whatever. And once you get big enough, you wind up being a target for lobbying like this. There's actually a multi-year effort by, some Jewish groups that were, labeled Morningstar as anti-Semitic, voiced some shareholder resolutions, really made their lives a living hell. And that's part of why we prefer to use data from activists, right? Because all of the stuff that's wrong with it, in terms of it's updated infrequently, it has errors in it, whatever, is counteracted by the fact that it's at least compiled with a consistent framework. And it's the stuff that comes out of those activist reports is unlikely to change. Because I mean, come on, like how often, like we've all picked activist targets before. Like, you don't pick the company that's doing most things okay but has one small problem. You pick the company that has big glaring issues. So each of these companies or each of these links are useful in terms of kind of bringing you to a database that has a whole bunch of information about companies that are involved in shady things. Um, Again, the other important to call out that the human, are an important source of this stuff. Right? Like often, I mean, the Morningstar thing that I shared came from a client who teaches English as a second language, has no background in investing, and was just concerned about this. And like, I think that when you meet fancy finance people who use big words and whatever, it's really easy to think that you couldn't possibly have any salient input into that process. I think that's just bullshit. Like if something doesn't make sense, you know it in your bones. And like it's important to really pay attention to that still small voice when you're thinking about this kind of stuff, because what I find is that, I've seen this time and again with clients who've come to us from other advisors. Things are going well, they're not really thinking about it. All of a sudden, the market goes down a little bit, and the ethical issues sort of manifest, and they cause the client to make impulsive decisions that are not in their long-term best interest. Because like maybe we feel like we can handle all of the ethical trade-offs of investing in JP Morgan while the stock is going up 25% a year. Maybe I don't, but maybe someone does. The second that reverses, all of that stuff, really gets re-examined in a panicky way. So like I encourage all of my clients to raise ethical issues with us. And we actually, when a client raises an ethical issue about something we own, our most common response is to integrate that into every portfolio we manage. Rather than because I think it's kind of irresponsible for me to say to a bunch of clients like, hey, you decide whether plastics is more important than climate pollution or whatever, or you decide whether you care about medical ethics. It's kind of my job to do that for you and give you the exposition to engage with those decisions if you want to. If you're looking just on something like fossil fuels, it's a lot simpler to do this screening. There are tools that are out there. There are a number of services that kind of are designed to just, help you divest from fossil fuels. This one, Fossil Free Funds from As You Sow, which is a nonprofit activist group, is really good. It's about as good as they get. One of the things that's kind of weird about it, though, is that the fossil fuel system is so huge. It will boggle your minds. And it's not just the upstream, midstream, downstream stuff that's directly involved in, emissions. It's the shipping companies that transport bulk crude over the water. It's the, oil field services providers and infrastructure providers that are treating the wastewater and whatever. There's an estimate that a group called Carbon Tracker, which put this flow chart together, put out that something like 40% of global stocks are existentially linked to the fossil fuel industry. So it may be okay to just exclude the biggest offenders. But important to note that there's a false precision that can come with this, where you sort of type something in, you get the result, oh yeah, no fossil fuels, and then that allows you to move through the world thinking that you've divested from fossil fuels when you own all these oil field services companies. We've talked a little bit about this issue with naive divestments, where you just own the stuff that you haven't come up with a reason not to own. This is a great example of why that's kind of silly. Right? Because you could very easily wind up just automatically buying all that stuff in a poorly considered strategy. There's also this option called direct indexing, which is basically it's similar kind of to what we do. You tell your advisor what you care about, and they create a custom index for you only that integrates that stuff. There are pros and cons to this, right? Like all sorts of things. The biggest pro is someone does it for you. Right. To me, that would be a con, because I would want to see what's going on in all of this stuff. And, often the data that's going into these things is not that well examined. Another big pro is that by investing in direct indexes, you often wind up with performance that more closely maps month to month with the performance of popular indexes like the S&P, which matters, right? Like, it's not fun to like open up the paper, see the stock market's up, then look at your account and see that you're down. Especially as you're in retirement, especially. The big problem with this, in my view, is that your personal solution will not get uploaded to other people. Right? So that's a situation where the advisor is relying on the client to identify, like what's going on and what they should do about it, rather than taking the responsibility themselves. And then usually using a third-party provider to create these indices or to create these custom portfolios. Um, it can be expensive relative to just buying a regular index fund. The fees can be like, 5, 10 times as much from a relatively small level. An index fund often has a tiny fee, something like 0.8%, if even that. Direct indexing solutions usually charge around 0.5% and are only available to clients with some threshold amount of money to invest. Most common that I've seen is 100,000, although it's becoming more popular to do for smaller accounts. I sort of think that this is a bit of a performative exercise, these direct indexes, because they allow the financial advisor to, basically deliver this performance of caring about what you think, and then outsource the implementation of that to a third party, and like focus their engagements with you around these ethical issues, how you're feeling, all these things, and it kind of becomes performance art pretty quickly, rather than what I consider real investing, which is where you are doing research and making decisions based on it. Bye, Javiria. Um, so, best practice, period, end of story, is find some intermediary you trust. I don't care if it's me. I would love to make referrals to other people for you to talk to. There are all sorts of providers out there. What I feel people are looking for, having had, uh, you know, God knows how many conversations with retail clients, is someone who will respond to an unspecified issue in the future in a way that satisfies you, without necessarily drawing it to your attention. Right? Like when the divestment demands for Israel started heating up, we were already aligned. We had to do some work to make sure we were fully aligned. But we already didn't own any of the high level companies. We already didn't have any Israeli investments. Um, and like that was pretty awesome to me. There are a couple of different models for folks you can work with. Our model is we take a fee of the assets that folks invest with us, and that's our compensation. There's also folks who will sort of sit with you like a coach, and work through the creation of your own portfolio with you, and sort of be there on an ad hoc basis as you need them. And then still others that specialize in, helping you find investments that are off Wall Street, which may or may not be, kind of those concessionary things that we talked about a little bit before, where you're not really generating market returns. But all of these things could feature in a portfolio, and like it's relatively common for us to say to a client, "Hey, like thanks for sharing all this stuff. We can't actually create a financial plan for you. Here are some people who could do it." Because like, in the world of financial services providers, it's very much like doctors. There's general practitioners and then there's surgeons. And we really are surgeons. We listen, we care, we pay attention to what people tell us about how they relate to investing, and what their priorities are. And then we build a portfolio for them. And then as their life changes, we cut it and change it. But for instance, like I have a client who is a retiree whose partner just died and is thinking about moving to a new city to be closer to her friends. That involves all kinds of financial planning stuff. Like what's the house going to cost? What's the move going to cost? What are you going to sell your house for? And the lack of clarity about how that was going to work wound up being kind of crippling, for that person. And every time we would check in with her, I would always say, "Hey, I'd love to refer you to one of these people to help to create this thing." So we have a great community of folks that we work with, and I love making referrals. Um, Next steps, if you want to work with us, schedule a meeting, fill out our onboarding forms. Many of you requested information on becoming one of our clients in the pre-thingy questionnaire. And in that case, I've been I'm perennially bad at email, but I will send out a note with some instructions on how to get that going, and set up kind of the personalized consultation process where we get to know what's going on in your life and work around how we can help. I just want to pull up my doc of the questions that we got that we didn't talk to. And let's see, Diana's asking, well, yeah, do you have suggestions on ways to invest in ethical and local companies? I think the best way to start is to start. Right. And like one of the things that's really fun about investing is there are all kinds of ways that you can control risk. If you're interested in doing this yourself and building your own portfolio, you can very easily divide an existing portfolio into, a long-term account and like an exploration account, where like maybe you take 5%, 10%, some, amount that's not going to kill you if you lose it. But that'll allow you to experiment and start, kind of building your portfolio. Often,
I'm
like
gonna trick you one day and give you like vegan bacon.
vegan bacon, hell yeah. Uh, the but yeah, like I think that, once you start the process of researching, you'll wind up. I experience it as something like pulling on a string in a sweater. Or going in a Wikipedia hole, which I'm sure many of us have experienced, where you go on that website and you wind up learning about the 13th Viscount of Austria or something for some reason. If you're really interested in this and your heart grows when you do it, you will find that it drives you to get better and better and better. I have some great PDFs and resources I can send to you if you are interested in kind of a loose training program, or some loose resources for doing it yourself, or even just to kind of get acquainted with, the art and the science and how they blend together of this whole thing. Very much not mandatory, very much an extracurricular activity. One of my friends says that trading the stock market is astrology for men. Where like there's sort of like like we sort of it's all very serious and whatever, but we're basically investing on vibes. Uh, and some like that notwithstanding, I think it's great. And that more people should do it. And I would love to help y'all kind of experience that. Um, shall I? I've basically monologued for a long time here.